Hello and welcome to Charting the Markets on Friday, the 2nd of June 2023. Now, the US debt ceiling bill has finally been passed and only needs to be signed into law today by the President of the United States, Joe Biden. And that has led to a huge relief rally in equity markets across the globe. And we can see here on the daily financial bed of the FTSE 100 that we formed a Harami pattern yesterday and we broke out to the upside today and have risen now above the 200-day simple moving average here in red at 7,532 and also through the 2-week downtrend line around 7,544. So short term, there is some bullish momentum entering equity markets on this risk on sentiment, and we could see some follow through to the upside over the next few days. And the first upside target for the FTSE 100 is the 22nd of March high at 7,587. And we'll have to see with regards to the US non-farm payrolls data later out today at 1:30 p.m. whether further upside could be seen with regards to the FTSE 100 and other equity indices. So if we were to rise above 7,587, the next upside target would be the last reaction high. That is to say, a high on the candle which is above the previous days and the next day's highs. And that one was made at 7,660. And that together with the low seen in mid-May at 7,679 represents the next resistance area for the FTSE 100. But short term, the development we've seen so far is looking quite bullish. Now, the German DAX 40 contract is quite similar in that we did drop to levels last traded in April of this year, this week at 15,625 on those US debt ceiling worries and whether it would the bill would be signed off in time by both the House of Representatives and the Senate ahead of the June 5th date, which would have led to the US being in default had no agreement been reached. But now that that has been the case, the DAX 40 has broken through this 2 to 3 week downtrend line at 15,942 and is heading up towards the late May high at 16,080. And this level needs to be broken through on a daily chart closing basis for the May high at 16,333, the all-time record high, to be back in play. So short term, we look positive here. We have to see obviously whether we can continue to do so on the non-farm payrolls data out later today. Average hourly earnings are also going to be very important. And all of this basically from a technical perspective means that we remain positive basically as long as we stay above 15,625. That's to say Wednesday's low on a daily chart closing basis, irrespective of what the macro data is saying. Moving on to the US, we've had the S&P 500 forming a wedge formation over the last few weeks, which potentially is a bearish chart formation if a breakout to the downside out of this wedge were to be seen. Now, this isn't the case at the moment because we are actually in the overnight session heading to levels last traded back in August of 2022 and are thus basically looking quite positive and could actually head towards the August high at 4,325. If further upside were to be seen after the new US non-farm payrolls data is out later today. Now, if that data were to disappoint, I mean, yesterday, for example, we had a very, very strong reading in the ADP employment data, especially in the private sector. And we also had annual hourly wages rising by 6.5% in the private sector. Now, that in itself has led to the rate hike expectations in the States with regards to the June meeting to rise to about 74% for another 25 basis point rate hike, according to the Fed watch by the CME. But at the same time, we've had several comments from Fed officials over the course of this week, which seem to be suggesting that they would prefer to see a pause in the rate hike cycle in June in order to assess the economic outlook in the US before making further decisions as to whether to hike the Fed funds rates to 5.25% to 5.5%, or keep it at the current level. So we'll have to see what will happen with regards to the US non-farm payrolls later today. But short term, as you can see here, the S&P 500 is also looking bullish and is trading in multi-month highs. Now here, provided we stay above the last reaction low, that is to say the low seen on Wednesday at 4,166, further upside is likely to be in store. The fact that the US debt ceiling agreement has now been reached, and that President Biden just needs to sign it into law later on today, means that the US dollar, which had been rising on flight to safety flows over the last few weeks, is actually coming off now. And the inverse of that we can see on the euro dollar daily financial bet. As you can see here, that has now reversed to the upside. We have bounced off our 2-month low at 106.36 and have broken through the May to June downtrend line, and basically retested earlier today the early April low at 107.89. So short term, we are seeing the euro, which makes up 57.6% out of the US dollar basket, outperforming the US dollar. And this slide we've seen yesterday in the US dollar, on the back of that agreement being reached with regards to the US debt ceiling being raised, has led to euro dollar heading higher. And if we were to rise above the early April low at 107.89, the next upside target and resistance area would be made up of the mid-February low and also the mid-April low between 108.04 and 108.32. And we really would need to rise above 108.32 for a medium-term trend reversal to be seen here, and for us to be able to rise back up towards the 55-day simply moving average, which currently can be seen at 108.19. So we'll see whether that is still the case later on today with regards to the US non-farm payroll data and average hourly earnings, and whether further strength can be seen in the euro versus the US dollar. Now, the US dollar is also looking weaker with regards to the British pound, because what we can see here on this daily financial bet is that the British pound has rallied quite strongly against the US dollar, and has done so over the last few days and accelerated to the upside, as rate hike expectations remain quite high for the Bank of England. Whereas because of some US Fed officials this week saying that they would prefer to see a pause in the rate hike cycle in June with regards to the Fed by hiking its rates, that interest rate potential differential has led to the expectations being that the Bank of England may hike rates and continue to do so over the next few months, whereas the Fed may short-term pause, even though market participants seem to think that the Fed is also going to hike rates by 25 basis points when you look at the CME Fed Watch tool at the moment. But let's see whether later on today the US non-farm payroll data will confirm what the US ADP employment data said already yesterday, and that is to say a lot of job creations being made there, which would force the Fed probably to hike its rates once more. And whether that will be the case with regards to US non-farm payrolls later on today, or average hourly earnings. So right now, short term, what we're seeing here with regards to cable is a retest of the mid-April high at 125.46. And this would need to be taken out on the daily chart closing basis for us to be able to head back up again towards the May high at 126.79. Moving on to another currency pair, euro sterling. Euro sterling dropped to levels last traded in December of last year on that interest rate differential between the European Central Bank and the Bank of England, or the anticipated interest rate differential, because we had over the course of this week a softer Eurozone headline in core inflation. And basically that meant that market participants didn't think that the European Central Bank was likely to hike its rates again at its next meeting. But when you look at the Bank of England, because of the consistently high inflation in the United Kingdom compared to its European counterparts, the Bank of England is very likely to have to hike rates even further in order to bring inflation down towards its 2% target. Now, that has led to euro sterling sliding very rapidly, as you can see here, over the last week, hitting a low which has been seen since not been seen since December of last year at 85.68, and you can see here we're trying to just hold here on short covering ahead of the weekend. But you can see here we've had 5 consecutive days of lower prices with regards to euro sterling. Now, if we were to next week fall through 85.68, that is to say this week's low, the next support area comes in at 85.48, that is to say the December low of last year. And then below there, we haven't got really much support until we hit the August low, the end of August low of last year at 84.09. So that would be the next downside target in case of this trend continuing over the next few days. Commodity markets have been influenced by the US dollar over the last few weeks, and now that the US dollar is coming off again, there is a surge in some base metals, for example, and we'll talk about gold and silver later on. But first of all, I'd like to talk also about the price of WTI, the price of crude oil. And as we can see here, we had a very sharp decline over the last week on weaker than expected data manufacturing data coming out of China. But that initially led to demand worries with regards to future demand, pushing the price of oil down by about 7% at the beginning of this week. But on Thursday, we had the Caixin private manufacturing index out, which pointed to an expansion in Chinese manufacturing, and that is actually the opposite to what the official figures released on Wednesday were saying, and this has led to the price of oil heading higher again. And as you can see here, we're now heading back up towards the April to May downtrend line around $72.54. So that would be the next upside target from a technical perspective. But basically, provided we stay below the 10th of May and the end of May highs between $73.82 and $74.70, further downside could still be seen and take us back down towards the March and May lows around $64.37 and $63.77. So these are basically the lines in the sand for this sideways trading range we've been in for the last month or so. And right now we seem to be heading back up again, also ahead of this week's or this weekend's OPEC Plus meeting, where Russia will probably be asked to stop selling really, really cheap oil to China, even though it did agree to cut its output as other OPEC members have done over the last few weeks. So it will be interesting to see whether we will see another OPEC cut announcement at this weekend's meeting, or whether the status quo will be maintained. Moving on to gold, what we've seen here, as I've just mentioned, is on the back of that stronger US dollar, the gold price had actually come off since the beginning of May from its 2082 multi-year high per troy ounce, and has since, over the last few days, risen now on the US dollar, starting to come off, and we're heading towards this orange line here, the 55-day simple moving average, and the previous support line going back to April, which now, because of inverse polarity, acts as a resistance line. And basically these levels can be seen between $1,991 per troy ounce and $1,994 per troy ounce. So that could lead to some short-term upside momentum here being capped, that resistance area. And the weaker US dollar could lead to further upside, perhaps next week, taking us towards the psychological 2000 area if the 1991 to 1994 resistance zone were to be taken out. Short term, from a support perspective, we've got the mid-April low at $1,970 as a support level, and also yesterday's low at $1,954 and the mid-May low at $1,952. That should act as support going forward. Now, last but not least, I'd like to mention silver. And here the story is quite similar to that of gold, in that we did come off on this stronger dollar over the last few weeks, But now that the dollar is reversing its short-term trend, at least, we can see some upside momentum in the price of silver, taking it also back up towards its mid-May high to $24.01. And then above there, if that were to be taken out today, we've got the orange line, the 55-day simple moving average at $24.30, and also the late April lows at $24.50, which could act as resistance in the next few days. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG. Have a lovely weekend.